Have you ever wondered how to access investments that can multiply your capital while traditional markets stagnate under restrictive regulations? In 2025, tech startups, such as those in artificial intelligence and biotechnology, offer exponential returns, like the case of an AI startup that raised $1 million in 2023 and achieved a tenfold valuation increase in 2024 after a successful funding round. In this video, we will uncover 5 exclusive opportunities in emerging startups that the Federal Reserve would prefer you overlook, keeping investors focused on conventional assets to avoid economic disruption. If you're a professional aged 30 to 50, passionate about entrepreneurship and innovation, with experience in venture capital, these strategies can transform your portfolio, overcoming regulatory barriers and unlocking significant growth potential. Watch until the end to discover how to diversify your investments with high-return opportunities. Let us now delve into the core challenge that this discussion addresses: the restricted access to promising startup investments due to stringent regulations enforced by the Federal Reserve's policies. These regulations, including accreditation requirements for investors, prioritize traditional assets such as stocks, bonds, and mutual funds to preserve economic stability, thereby preventing the disruptions that radical technological innovations could introduce. To illustrate, the global venture capital market reached approximately $286 billion in total capital raised in 2025. However, only about 15% of individual investors have direct access to high-potential startups, according to industry trends reported by sources like PitchBook and CB Insights. This limitation significantly impacts ambitious professionals, those in their 30s to 50s with backgrounds in entrepreneurship and venture capital, who are eager to pursue exponential returns but find themselves confined to lower growth options. Furthermore, the Federal Reserve's monetary policies, such as interest rate adjustments, further deter capital flows into high-risk ventures. This scenario underscores the urgent need for a shift toward portfolio diversification that fosters exponential growth, in line with interests in cutting-edge technology. Moving forward, we will examine 5 specific investment opportunities in emerging technology startups, each with technical insights, practical examples, market data, and benefits tailored to our audience. First, consider startups in generative artificial intelligence, which develop models for process automation, digital marketing, and content creation. These companies leverage advanced deep neural networks to handle vast datasets and produce innovative outputs. A practical example is a firm that secured $5 million in a 2024 seed round and is projecting a 300% growth in 2025, driven by surging demand for automation tools in e-commerce sectors. The generative AI sector is anticipated to grow at a compound annual growth rate of 37.6% through 2030, according to Grandview Research. For investors seeking high-risk, high-return prospects, this presents potential returns of 8 to 12 times the initial investment within 3 years, making it an excellent fit for those experienced in capital allocation. Next, we turn to biotechnology startups focused on longevity, employing genetic therapies and anti-aging solutions. These ventures utilize techniques such as CRISPR gene editing and biomarker analysis to create personalized treatments. For instance, a genetic therapy company experienced a 7-fold valuation increase following FDA regulatory approval in 2024, delivering substantial multiples to early investors. The biotechnology market is valued at approximately $1.74 trillion in 2025 and is expected to expand at a 12.5% compound annual growth rate through 2034. This opportunity provides exposure to ethically driven innovations with societal impact, enabling portfolio diversification for professionals interested in health and technology intersections. Our third opportunity involves platforms in quantum computing, where startups build hardware and software for complex simulations in finance and pharmaceuticals. Key technical elements include qubits and quantum algorithms designed for optimization tasks. A notable example is a startup that raised $10 million in 2023 and secured major corporate contracts in 2024, resulting in a five-fold valuation uplift. The quantum computing industry is projected to reach $65 billion by 2030, as estimated by McKinsey Analyses. This nascent field offers disruptive potential, with exponential returns appealing to venture capital-savvy investors. Fourth, we explore advanced cybersecurity startups that integrate artificial intelligence for real-time threat detection, incorporating machine learning for behavioral analysis and enhanced encryption. One such company safeguarded 50 major clients in 2024, yielding 15% returns for initial backers. The cybersecurity market is forecasted to grow at an 11.6% compound annual growth rate through 2029, reaching $396.8 billion. This aligns with the need for digital risk mitigation, providing high-demand investments for those prioritizing innovation and robust returns. Finally, consider startups in clean energy technologies, specializing in advanced batteries and renewable integration, often enhanced by AI for efficiency. An example includes an energy storage firm that doubled its valuation in 2024 through automotive partnerships. The clean energy sector is estimated at $1.7 trillion in 2025, according to International Energy Agency projections. This investment combines consistent returns with environmental, social, and governance alignment, ideal for sustainable diversification. To contextualize these opportunities further, it is essential to understand the Federal Reserve's role in discouraging such investments to maintain the economic status quo. Through monetary policies like interest rate hikes and accreditation mandates, requiring, for example, a minimum net worth of $1 million for qualified investors, the Fed limits access to venture capital markets. Data indicates that in 2025, approximately 18.5% of U.S. households qualify as accredited investors. These constraints disproportionately affect qualified professionals in their 30s to 50s, preventing them from engaging with high-return prospects in areas like AI and biotechnology. By favoring traditional assets, the Fed aims to avert disruption similar to past tech bubbles, yet this perpetuates limited access and stifles innovation-driven growth. Addressing this, practical solutions include investing through equity crowdfunding platforms such as Seed Invest or Republic, accessible venture capital funds, and angel investor networks. These avenues promise a transformation, diversifying portfolios to achieve exponential growth while bypassing restrictive regulations. Recall the AI startup example that achieved a tenfold valuation increase, accessible via equity crowdfunding and delivering impressive multiples to individual investors. In fact, crowdfunding platforms facilitated the raising of approximately $34 billion in 2024, with continued democratization of venture capital in 2025. This approach can yield 5 to 10 times returns over 3 to 5 years, tailored to entrepreneurship and innovation enthusiasts. Begin with thorough due diligence, risk assessment, and technical evaluation to ensure informed decisions, fostering a sustainable financial transformation. Now let's explore how to evaluate these startup opportunities to maximize returns while managing inherent risks, a critical step for professionals seeking high-growth investments. Start by assessing the founding team's expertise, ensuring they have a proven track record in their domain, whether it's AI, biotech, or quantum computing. Next, analyze the startup's market traction, such as customer acquisition rates or signed contracts, as seen in the quantum computing example that secured corporate partnerships. Financial health is equally vital. Review burn rates and runway to confirm sustainability. For instance, the clean energy startup's valuation doubled due to strong revenue streams from partnerships. Use platforms like Crunchbase to verify funding history and competitive positioning. Risk mitigation involves allocating no more than 10 to 15% of your portfolio to high-risk ventures, balancing with safer assets. In 2024, diversified portfolios with 10% in startups outperformed traditional ones by 7%, according to a Morgan Stanley report. This disciplined approach ensures you capitalize on exponential growth while safeguarding your capital. Let's examine a deeper case study to illustrate the potential of these investments. Consider a biotech startup specializing in CRISPR-based therapies for rare diseases. In 2023, it raised $8 million in a Series A round at a $40 million valuation. By 2025, after successful Phase 1 clinical trials, its valuation soared to $300 million, offering early investors a 7.5x return. Key to this success was the team's expertise, PhDs from MIT and Stanford, and strategic partnerships with pharmaceutical giants. Due diligence revealed a strong patent portfolio, protecting its technology from competitors. Market data supports this. The global CRISPR market is projected to grow at a 19.6% CAGR through 2030. For our audience, this case underscores the importance of technical expertise and market validation when selecting startups, enabling confident investment decisions with transformative potential. Navigating regulatory barriers is another critical aspect for U.S. investors seeking startup opportunities. The SEC's accreditation rules, limiting venture investments to those with $1 million in net worth or $200,000 in annual income, exclude many qualified professionals. However, recent reforms have expanded access. Regulation crowdfunding, updated in 2025, allows non-accredited investors to allocate up to 10% of their income or net worth to startups, with platforms like StartEngine facilitating deals as low as $500. Additionally, Regulation A+ enables startups to raise up to $75 million from the public. In 2024, over 1,200 campaigns raised $1.2 billion through these channels. For our audience, this means leveraging platforms like Republic to bypass traditional gatekeepers, aligning with your entrepreneurial goals and enabling portfolio diversification without needing accredited status. Looking ahead, let's consider emerging trends that will shape startup investments in 2025 and beyond. Artificial intelligence is evolving toward autonomous systems, with startups developing self-learning algorithms for industries like logistics. Biotech is advancing in precision medicine, with firms targeting individualized cancer therapies. Quantum computing is gaining traction for financial modeling, while cybersecurity startups are integrating zero-trust architectures. Clean energy is pivoting to next-generation solar and hydrogen solutions. These trends align with a projected $350 billion in global venture capital funding for 2025. For professionals, staying ahead requires monitoring platforms like CB Insights for real-time data and attending industry events like TechCrunch Disrupt. This proactive approach positions you to capitalize on the next wave of innovation, ensuring your portfolio remains competitive. To bring this together, let's outline actionable steps to start investing in these opportunities. First, identify your risk tolerance. High-growth startups may offer 10x returns but carry a 70% failure rate. Second, select a platform like Seed Invest, which vets startups for financial stability and growth potential. Third, conduct due diligence. Verify the team's credentials, market size, and competitive edge. For example, the cybersecurity startup's success stemmed from its proprietary AI algorithms and Fortune 500 contracts. Fourth, diversify across sectors. Allocate funds to AI, biotech, and clean energy to spread risk. Finally, consult a financial advisor to align investments with your goals. In 2025, investors using this strategy saw average returns of 12% per a Deloitte study. These steps empower you to transform your financial future with confidence. In summary, these 5 opportunities in emerging tech startups, generative AI, longevity biotech, quantum computing, cybersecurity, and clean energy, provide viable alternatives for overcoming regulatory hurdles and enhancing portfolio performance. By leveraging crowdfunding, angel networks, and rigorous due diligence, you can achieve 5 to 10x returns over 3 to 5 years, as demonstrated by the AI startup that multiplied its valuation tenfold. Subscribe to the channel for more innovative investment strategies. Give this video a like, share it with your network, and comment below on which opportunity excites you the most. The future of investing is within your reach. Until next time.